Fantastic. Okay, we'll let people get in here. We're a little bit late today. That's okay. We got an exciting podcast for us. We have people to show up. And I think we're going to get started here. Good morning to you. Hi, I'm Anthony Parent of IRSMedic. We're going to have a little bit of fun today. We're going to be talking about estate and financial mistakes people make in their estate and financial planning when they're overseas. And also, this advice also applies for people who are in the U.S. and considering making foreign investments. A lot of this does apply as well. So it's important for anyone. So anyone kind of investing internationally, this would be, and that U.S. personhood is attached. This would be a great podcast for you. And we are taking your questions. So we want to get questions. And so really the first place we want to start off, though, is a little bit of follow up on what we've been doing and on our advocacy work. And, you know, the burdens of international taxation, double taxation are extreme. We're going to see these issues erupt more and more over the next 30 years. And really, the big news, and I think the big news that people know, or it's not really news, it's kind of old news, but the next 30 years, we are going to see the biggest wealth transfer of all time. As our baby boomers are moving into the sunset there, we are going to see the greatest wealth transfer of all time. And I think this is something that I think about. Now there's something like 7-8 million U.S. expats overseas, right, Keith? With me is Keith Redmond. Keith Redmond, the global admin. He's gonna lead off. But Keith, there's a lot of 6-7 million overseas, right?
Yeah, I mean the latest State Department figure they estimate is 9 million, but the number varies depending on the entity. But you know, it's a significant number of people overseas. So and it ranges anywhere between 7 and 9 million.
All right, great. Well, that's Keith Redmond. I didn't give his introduction yet for those new to the channel. Keith Redmond's been a long-term guest, and Keith is a global navigator, the formidable Keith Redmond. And Keith has talked to hundreds, thousands of U.S. expats about their financial decisions over the years. He runs a Facebook group that's now over 12,000 at here. And so he's going to be discussing the common questions people have about estate planning, investing, and some of the mistakes people have made, and he's going to go over those. But before we get to that, I want to introduce our other great guest, none other than the great John Richardson. John is coming to us from Toronto, Canada. Does he have his 32-ounce McDonald Land coffee with him today? Does he this morning? Yes, he does. He is powered up, ready to go.
He's a good American.
He's a good American. But before we get now, John has been, you know, really, I would say this, I always say John provides the intellectual backbone to our movement to remove double taxation. He's been doing this for over 10 years, really at issues that people didn't see. Now people are seeing it, including myself. John has been at the forefront of these issues, advocating often to himself, but now there's a lot more people interested in this, and there's really been a growing concern for a lot of the abuse. And so there is a move, and we, you know, John, Keith, and I were all part of the effort to get, you know, it was Solomon, who got it, but got Donald Trump to propose the elimination of double taxation for Americans abroad. That didn't make it into the one big bed. We're not exactly happy, but we know Solomon isn't resting. So the thing is this is what we're looking for. Again, and this is what I want to say for people upset at Solomon that Donald Trump didn't honor his promise to Solomon. Well, guess what? Solomon hasn't stopped, and he is the one who got this whole ball rolling. Solomon is the one. So we are seeking, and I want to go to John's page right here. John, I want to just go to your page right here and start off with you and just sort of the call to action that you have people that you want people. Let me get this here. Let me get this page up here, and what you want people to do because as we get into this, you're going to see the craziness, folks. You are going to see the craziness, and there does need to be some sort of relief. So John, I'm on your page, Citizenship Solutions at CA, and I'll share this in the super chat. So if anyone wants to follow the link, you can do that. But what is the call to action that you would want people to take here?
Right. So the YouTube is a link to our last podcast. Well, basically, the problem is that although I certainly would agree that people in the United States are not interested in U.S. citizens abroad, they do have to know something about the problems faced by U.S. citizens abroad to, have any sense that anything needs to be done about this. And so basically what we're seeking, and we've done this before, but this is particularly important now because of the the specificity of the Trump pledge, which was to end double taxation. And that can be interpreted, I think, in a lot of different ways. The one extreme, it can be, the basis of double taxation is dual tax residency, and U.S. citizens are always tax residents of the United States when they live in another country, making them dual tax residents. So, on one level, it could mean ending citizenship taxation. On another level, it could be ending the although American citizens are always double taxed, did I say always double taxed? They just don't quite realize it because they confuse being double taxed with their total tax bill. And they think that, if they end up paying, for example, the higher of the taxes in two countries, they're not really being double taxed, but they are, because the way that the U.S. taxes are paid, is through foreign tax credits often and things like that. So make no mistake about it, when somebody asks, what is the meaning of American citizenship? The answer is double taxation.
Double taxation and being proud of it. And I think there's sort of
they're very proud of it.
There's a proud arrose and ignorance. It's a combination of ignorance, arrogance that Americans
citizens are even worth double taxing.
And it is there is no people more programmed than Americans.
That is true. But the key point here is this. So you're not going to get support on this inside the United States. But the key point is that we need reasonable, objective, descriptive testimonials of exactly how people experience the U.S. tax system, and not this stuff that, I have to file a tax return. That's not going to resonate, okay? All Americans are abused by the tax system, regardless of where you are. We're looking for things that clarify, describe, and provide a visual portal into the special problems experienced by Americans abroad. And these can be things like GILTI, the transition tax, foreign trust problems, PFIC, even the issue of, many people don't know this, if you're married filing separately, which many Americans abroad do, if they're married to, one of those, what's that called? Alien people, right? They have to file a tax return if they have as little as $5 of income, if they want to file married filing separately, right? So, there's all kinds of stuff out there. And we need these written testimonials, and you can send them to me, and I'll even help you improve them if necessary. And you can send them to me at...
here's your email right here. I'm putting it right here. You can send them to John right there. And I would say this, and also one of the things I think is really important, this is the illustration, this is the humanization of the dehumanizing process. I think one thing that would be incredibly helpful for people to share too is their experience trying to rectify the issue. That, look, I take over a lot of cases of other tax professionals, and what I see is just horrific. And the abuse, and I'm not going to mention the firms, there's some larger ones who are known for essentially blackmailing their clients. The client says, hey, look, I'm thinking about disclosing, I want to do this. And I've seen this happen where the firm says, you're going to do it this way. And if you don't do it this way, I'm going to report you to the IRS.
Yeah, right? This is, this is not particularly common, but it does exist. And make no mistake about it, those of you who are listening, make no mistake about it, okay? Who you contact to discuss about this stuff makes a huge difference. And I would go so far as to say in many cases, your choice of conduct determines your destiny on this type of thing, okay? So you need to be very, very careful. I would also make the point, and I'd like to do a podcast on this. This week, this is the last week of August, leading into Labor Day weekend. And 14 years ago in 2011, many people have forgotten or don't know about this, tens of thousands of Americans abroad were trying to come to terms with whether they were going to enter what the IRS was doing at the time, this thing called the Offshore Voluntary Disclosure Initiative. And, the panic, the trauma. If somebody said, what does tax terrorism mean? You'd say, well, look to the 2011 OVDI thing, where basically what was happening was that American citizens abroad were effectively invited to turn over 25% of their net worth to the IRS for no reason other than, a promise to not, go after them, et cetera, when in many cases the penalties, would have been far less and I did write a post on this, but
Yeah, I want to get that. I'm going to get that. I'm sharing that right now because I did see that you just updated that. So let me just share that here. And here we go. So so you know that, oh my God, John, this does bring me back to 2011. And I think one thing important to remember in 2011, it was one size fits all. One size fits all. If you missed a form because you didn't know and things were complicated, you were treated as bad as if you were someone who intentionally moved money overseas in 1983 to
no,
a
you were
Swiss
treated
account.
worse, Anthony.
Yeah, actually, yeah, no, you're right. Because if you were one of those, you got a 20% penalty. That's right.
Yeah, no,
That's right.
This warrants. We absolutely have to do a separate discussion of
All
this.
right, yeah,
I
we'll do
think
that, yeah.
what people need to understand is this, okay? That if you have concerns about aspects of the U.S. tax system, whether you're complying, anything around that at all, what your tax return should look like, you need to be very careful who you contact. Okay, very, very careful, because one of the things that I'm not directing this at any firm specifically or any individual specifically, but I read a very interesting article on this OVDI thing last night. A few years after, somebody was questioning how could people have been so stupid to have entered this program, and a lot of the finger pointing was on the quality of the advisors. Okay, just terrible advisors who didn't even understand the IRS penalty regime to begin with. I mean, one of the things that was extraordinary about this was, this offer to turn, what the way it was phrased was basically, 20, without getting into the technicalities, they wanted 25% of the value of your offshore, meaning non-American assets. So for an American abroad, that would mean 25% of their net worth, right? And of course, the only way to get that would be to liquidate the assets and pay the tax in the country. So really, it would have been 50% of the net worth. And there, and there were people who did this sort of thing, right? I mean, it was absolutely extraordinary. But what was fascinating about this was that this was an absolutely made up, fabricated program penalty regime that is nowhere to be found in the law. Nowhere. Nowhere. Not there. Not found in the law. And it reminded me, very much of just sort of a mafia chief saying, if you don't want me to go after your kid, you're going to have to pay us some money type of thing. In other words, this had nothing to do with any statute authorizing these penalties. It was completely made up. Now, maybe it's legal for them to make this stuff up, but for this to have gone on, and for, as far as I can see, nobody, although the taxpayer advocate did provide some help to people, point this out was simply unbelievable. But in any case, the moral of the story is this: not all tax people are the same. Believe me.
Oh God, right. Well, thank you for that setup, because I think this really brings it to the issue because of the PSYOP and all the pain that people have been through. And now, and I think that's really the setup, what many Americans have been through, and you have to understand what's coloring the perception of a lot of people. So with that background, I want to go over to Keith Redmond and just start talking about, some of the basically going over what he's been doing these years. Keith, you have been talking to thousands of U.S. expats. So what do you do, and what are the common things that come up? Why do people reach out to you? You're muted, bud. Still muted. Hang on. Oh, not sure, Keith. We're not getting you. All right. Keith will hopefully be chiming in a second here. So Keith, one thing I do want to get, and hopefully Keith will get with us very quickly, is this on something to think about, and something that I'm thinking about right now is that when the U.S. government offered its voluntary disclosure program, these are a few things that happened with it. Number one, they were threatening if you didn't do it, they were going to come after you with the full weight of the law for quiet disclosures. That was the first issue. They were threatening people with
Okay.
unbelievable
Can you hear me
penalties.
now?
Yeah. Hey, Keith. Yep. And I just want to finish one thought. We're going to go right over to you. And then the second thing is this: in any contract, there needs to be consideration. That you can't have a contract where there's no consideration. Yep, Keith. Keith, you're back. We hear you. I'm just going to finish up one thing. The thing is this: there is no authorization for an FR penalty. There actually isn't. And so I think one thing is the IRS created this whole thing for people to avoid FR penalties that they didn't have a legal right to assert. So that'd be an interesting thing. Now, Keith, good morning to you. And now I want to ask you about what you have been doing. Why do people call you? What are the things that come up? You've talked to thousands of U.S. expats. You run a group of 12,000 people. Generally, a lot of Americans who are married to foreign spouses living overseas, their financial center of gravity can be overseas. Maybe they'll have something in the U.S. So what are the things that people are asking you? And you're really the one who's driving this podcast. You're like, Anthony, I think we really need to do this one. So what's really driving this?
Well, I certainly, people call me. Can you hear me okay?
Yep, we got you.
Okay. Yeah, I mean, the common thread in which people call me is certainly fear. They don't know where to turn. They don't know what to do. And, what I've noticed is that a lot of Americans overseas, they will invest in financial products in their respective countries of residence. Now, that American overseas may or may not be in the U.S. tax system, or they either are current or they haven't been in for a number of years, or they never have been. Nevertheless, they will invest in financial products in their countries of residence without taking a look to see how that will be recognized or not recognized vis-a-vis the U.S. tax system. And then they have unpleasant surprises when they go do their U.S. tax declarations, whether they do it every year or if they're not in the U.S. tax system, they may have to enter down the road. For example, if they're getting, let's say, an inheritance from the U.S. and it's a taxable event, and then they have to do, some back filing, and they realize, wait a minute, that tax deferred financial product in France where I invested is not recognized by the IRS. Therefore, it's not a tax deferred product. So there needs to be some proactivity before you take any type of financial action in your country of residence. That's number one. Number two, people who set up businesses, they don't take a look at how that would be recognized or not recognized by the IRS to see, well, okay, if I set up this business this way, how is that going to look vis-a-vis the U.S. tax system? Whether that be in the immediate or down the road, because I may have to enter the U.S. tax system. Or I want to set up this business, but it's best for them to renounce before they set up the business.
Yes.
You see what I mean?
There
There needs to
those
be
are,
proactivity when it comes to that. And also, I do get on the occasion people who are, whether they're moving back to the U.S. or they're moving from the U.S. overseas, and they don't do and again, I'm being intentionally repetitive, their due diligence ahead of time to see how their financial actions are going to be treated with the U.S. and with their country of origin or their country of residence. And so that is a common theme that I get where they call me after the fact and they're in a situation where, oh my God, I didn't know that I shouldn't have invested in that financial product. So the objective of what I'm saying is to proactivity before you do anything. It's very important.
I think you said something very, very important, Keith. And I would say here's a common life example of it. This is the first time I encountered it. Years ago, starting to do Oxford disclosure work. Life insurance. Life insurance is a fantastic product, right? You insure your life, and there's a death
benefit. And are you speaking of life insurance in the U.S., Anthony?
I am speaking of life insurance in the U.S., right? It's a great thing. You get your You put your money into life insurance, and actually, many people don't know this, but the best tax shelter in the world, if you're super wealthy, really could be something called a private placement life insurance policy. It's basically your own policy. You put your portfolio in an insurance wrapper, you borrow against the death benefit, which is tax-free, and then when you die, the loan is paid off with the death benefit. It's one of the most sophisticated, greatest tax dodges. Unfortunately, you got to be a little wealthy for it. Like if you're over 10 million, that's where it starts to make sense. Yeah, no, not for everybody, but it really can be one of the best ways to avoid taxes. But there's one thing. The U.S. tax code says, no, you know the only thing that's special in this world? The only thing that's special for life insurance is U.S. life insurance. All other life insurance, it's an investment. And I think the one that cracks me up is in France, where you have an assurance V, which
Right, which
literally
is different than
translates
life insurance in the
it
U.S.
translates into life insurance, but it's not.
It's not, right.
Yeah. Do you want to talk about your assurance V a little bit? Have you encountered that, Keith? A lot people come with that. You probably have one yourself.
Yeah, no, I've encountered that because, when it comes to it gets quite complicated when it comes to the IRS, or I should say the U.S. tax code, when it comes to
Yeah.
assurance vie. I mean, I even know for myself, there's other things in France to invest in that is a great investment for your future, for your retirement. And even though
Yeah.
the U.S. France tax treaty is quite beneficial, there are still products that because they are not recognized by the IRS, you're actually doubly taxed. And I know a few of them off the top of my head where because of it, you're tax going in and tax coming out.
Yeah.
So you got to be really careful before you put your money into any financial product.
Yeah, that's right. And I would say life insurance is a big one. John, can you think you have anything big off the top of your head that people maybe shouldn't invest in?
You mean just generally?
Yeah, I mean, well, insurance, life insurance is the first thing that pops to my mind when I think, be careful. If you're a U.S., don't watch out. If you're a U.S. person, watch out for that. That's going to be my first warning is
Well,
watch out for.
so
Now, a foreign life insurance can qualify. They actually can go and do it. And also, as I was saying, some of those private placement life insurance policies do create offshore policies, but they are accepted as it. But generally, for the most part, most foreign life insurances don't meet the 7702G
well,
definition.
that's right. That's right. I mean, presumptively, life insurance products that are not U.S. are not treated as insurance. From the perspective of the Internal Revenue Code, which means they just become a financial product, right? Which means income inside them is taxable. They may be P-fixed, et cetera, et cetera. I mean, it's basically if you're a U.S. citizen and you're living outside the United States, the way to think about it is everything is prohibited unless expressly allowed.
Yeah, and I
Yeah,
think you have two nasty surprises. Number one, you're taxable overseas. Number two, the things that would be tax exempt in the U.S. are taxable outside. And by the way, the tax treatment is even worse than anything in the U.S. So actually, it's three losses, and then you also might lose foreign tax credits paid because they didn't line up quite right. And you're paying someone a lot of money to calculate these. And so these are the things, by the way, that will keep people from complying. One of the things that people won't do is like, well, I don't want to financially ruin myself. And that's really
right.
why, I mean, but at some point, and this is the thing, at some point, somebody may have to get in compliance. And really reason why now people get in is because there's some inheritance. There's going to be,
Where it's going to be a taxable event.
yeah. And so that's why it's like, you might want to hey, look, we get, and I think, understand our point. Like, look, we understand
Right.
compliance might not be possible for you this year. You may have to do it in the future. Let's talk about not making it a nightmare in the future.
Right. And if I
That's
may
what we're
add,
trying to avoid.
Anthony,
Yeah.
the other thing that I get is that, people who Americans overseas who are not in the U.S. tax system, and they know down the road they're going to get an inheritance from mom and dad in the U.S., but they have no idea what is in that inheritance.
Yes.
And I tell them, you need to sit down with mom and dad and go over it to see, are there going to be taxable events? Okay. Or can that inheritance be recalibrated where you walk away with cold hard cash? Maybe other things can be your siblings get, but you walk away with cold hard cash. So you really need to sit down with the person or persons whom you're going to be a beneficiary to find out what that's going to be about before they die. Very important.
and because they really might have the wrong thing for you. And this is,
Right.
I'll tell you what, this can cause a lot of angst among siblings when you're the one who's overseas and you got all these
Absolutely.
problems, right? And that's like you're the black sheep of the family. It's not a lot of fun. Now, I do want to get you got a big question in, and we're going to get to this because I think this question is really, really helpful
Yeah.
to understand. And let me get this up to the stage here. Let me add this here. Okay, so wait, that's not it. Hang on, let me.
It's the one that I sent over to you in
Yeah.
an email.
I don't know why. Hang on a second. I got to remove this. I'm doing a lot of multitasking here. So.
Yeah, that's all right. A gentleman this morning had posted, or at least, posted.
Yeah. I want to get to that question here. Let me remove this. I got it. Okay, now at the stage. Nope, still not doing it. It's John's. Oh, there it is. It's John's screen share messing it up. There it is. All right. So here it is. Hopefully we can see it here. So here's generally the question. And this I think is a great one. UK is a huge. I think UK is the number one. Canada, UK, and France are really the top 3 countries that we encounter. We'll find US expats, and these are the issues. So correct me if I'm wrong, but in the UK, and EU residents are taxed on all income regardless of where it's from. Capital gains are also taxed in the country where they are earned. Nearly universal AFAIK. Now I would just say this, like, well, that's not quite true. The premise isn't true. They're taxed on all income, provided they're living. You're right. Again, they're residents in the EU. Then they're taxed on their worldwide income. Correct. But if they leave, they're not taxed on worldwide income. So it is a little bit different. But generally, I would say that first part is correct. Generally, I just wanted to make that distinction. Most countries, UK and EU, offer some relief from double taxation. Capital gains would be U.S. sourced income and subject to double taxation for EU citizens residing outside the U.S., for example. Of course, they can apply for relief in their country of tax residence. I am not seeing how this is different than how other countries handle residency-based taxation, unless I am missing something. Well, again, I think the first thing is that the country you're residing in Europe is taxing you because you're a resident. You actually live there. So you're not taxed by virtue of your citizenship. Okay, so that's one distinction. And now one thing we've never discussed on this channel, and we will be doing a dedicated podcast, I guess, is that we've never covered estate and gift tax treaties. So we will be discussing those and more, and we'll probably go through and hit more of the popular ones first, and then get to some of the ones that impact the most. So, John, can you walk us through a little bit of estate and gift tax treaties and how they work? And are they different than regular income tax treaties? What kind of problems do they cause?
Well, yeah, they're different treaties. Okay, they're different from income tax treaties. And there's a difference between an estate tax treaty and a gift tax treaty. Okay. The one exception is Canada, because Canada doesn't officially have estate and gift taxes, although it clearly does, really. They just do it under the income tax system. So the Canada-U.S. estate tax treaty, which it actually is in the income tax treaty. That's the only exception I know of. There aren't that many of these, by the way. There's only about 60. And 15 rather. And what they're essentially aimed at doing is making sure that people, they do 2 things. When both countries impose a estate and a gift tax, okay, what they try to do is make sure that taxes paid in one country is credited towards another. The second thing they do is, decide whether a country or, when it does not have the right to levy estate or gift taxes. A third thing they may do, okay, is increase the quantum of assets before these types of things kick in. For example, you're a non-resident alien and you own U.S. situs property under the Internal Revenue Code. It's a $60,000 threshold. My memory is, I may be wrong on this, but Australia is a treaty that bumps that up extremely significantly, et cetera. So those are the things that you're looking for.
Now, one question I have is I just realized
the other thing they do, by the way, sometimes is, and this is important, is they exempt people from certain, another part of this is what are inheritance taxes, right? Inheritance taxes are taxes paid by the recipient inheriting something, right? And some of these treaties, for example, the Ireland one, I believe, will exempt U.S. citizens in Ireland from Irish inheritance tax on some U.S. situs assets, et cetera. So, they operate more or less in that area.
And then this is sort of the problem I was thinking of, because in this question we have that, it's like, in the U.S., your parents pass, provided it's their property and things are done right, or it's done through an incomplete gift and a grant or trust, the child will get the stepped up basis. Okay. So let me walk through the basics of how it works. Okay. Parents have a house in, say, Bethesda, Maryland. And they bought the house for, say, $50,000 back in 1962. They passed, and now the house is worth $3 million. That house will go to the heirs with a basis of $3 million, so that if they sell it that day for $3 million, they have zero gain under the U.S. tax code, zero tax due. But I'm thinking of something here. Well, if you're living in the UK, there's no stepped up basis. So I've never encountered this issue before, but that's the little question mark I have there. Like, wait a second. Does the UK know and that you didn't have to pay taxes because you had a stepped up basis that took away the gain? And would they seek to do that? That's a really, and these are the intricate issues you get into with double taxation. These are the problems that you get into when you see this, because you're not thinking of this clearly. Do you see that?
Yeah. So, I mean, the whole UK thing is, it's complicated, but it's also in plain sight. There are, I believe, and I was describing this to somebody recently, all kinds of interesting opportunities to, if you're an American citizen living in the UK, and let's say you have a house worth $3 million.
Okay. Oh, by the way, I just want to interject. There is no gain in the UK. They don't have a stepped up basis, but they have another way to deal with it. So just want anyone there worried about it, you're okay. There is a way to deal with it, but it's an issue that could come up. Anyway, back to you, John.
Well, so you can combine the U.S. Gift tax limitations, right, and things like that, with some of the UK rules, okay, for being able to transfer property, tax free, etc. To, in this case, get somebody below the $2 million for expatriation and that. But I mean, there's no question that this stuff is a problem, and I don't think that the U.S. tax system is particularly punitive on issues of death. Okay.
Okay.
Certainly far less so than
it used to be a lot worse.
The situation in other countries. I mean, Canada's incredibly punitive. I mean, I'm amazed that people actually swallow, this concept that Canada doesn't have a death tax, hook, line, and sinker. Canada is the worst set of death taxes in the world. Anybody who owns any property that's appreciated 1 cent pays death taxes in Canada. But yet somehow, they're never in the discussion of, countries that levy this kind of stuff. But look, I mean, this is sort of a blend of issues of tax residency and where property is located, things like that. I think it's almost impossible to generalize here.
Yeah.
The only thing that needs to be generalized is what I stated initially, is that you got to be proactive before you do any type of investing in your future as an American overseas. I think that's across the board as far as the top line generalization.
So, and I would say,
I think that's right. People are not, they're not going to do that. Okay.
And I would say,
it's their problem.
I would think there's going to be some things that you say, look, you got to talk to a U.S. tax professional about. Okay, are you going to get into a business? Are you going to be a beneficiary?
Have to
Are
do
you
it.
going to get in a foreign business? Are you going to invest? Are you going to be a beneficiary of foreign trust? And I want to talk about that right now because actually sometimes, and this is what can happen, and this is what I see happen, that there can be someone who goes, and this is actually Keith, you actually know this case as well. This is
Yeah.
somebody you talked to and sent over my way
Yeah.
because he was in a real pickle. But this was a situation he
Oh
had.
yeah, a real pickle.
He and his brother were the beneficiaries of some exotic corporate trust thing in Liechtenstein. And when I see something from Liechtenstein, I'm like, okay, look, this is going to be a high end thing. Somebody spent a lot of money to get this. And well, anyway, as you explained, Keith, he had this tax attorney who was getting him into compliance and presented him with like $2 million bill or something like that. And we looked at this, and I'm thinking, like, wait a second. Here is a father worth millions of dollars, and he knows his sons are U.S. persons, and the thing that he did is he decided to spend a ton of money on the highest level legal work in Liechtenstein to create a plan that would create a total nightmare for his sons when they inherited. I'm like, that doesn't make sense to me at all. And again, I looked at the attorney who was helping him with this streamlined disclosure, and I looked at that $1 million bill, and I looked at it. This doesn't look right at all. Well, researched it. We did research it. We found out that this was a hybrid entity in Liechtenstein. It could be considered a corporation or a trust, and there was an extensive area of law on this very highly sophisticated thing. And it really came down to, hey, how does it function? Does it function as a corporation? Does it function as a trust? Well, we said, well, the entire purpose of this thing was a succession plan. It was a trust. And because we could interpret it as a trust, the tax bill went from whatever it was, millions of dollars, to nothing. And he got the stepped up basis. And so I think one thing to be aware of is that you might have the right plan, but you got to make sure you go to someone who understands and can find and is looking to see you got the right plan, as opposed to someone who doesn't know what it is and is just like, oh, it's just a corporation and just you're going to get whacked. So that's something that we see too is that people will go and get advice. But then, as John said at the beginning of this, there are night and day. Tax professionals are night and day. Levels of understanding, levels of inquiry, levels of sophistication on how the world actually operates. It does matter. Not everybody, some people know taxes and that's it. That's it. They don't know people. They don't know business. They don't know anything else. They just know taxes, which when you think about it, isn't really a lot. Not a lot. How does it interface with reality is sort of where the value is at. So I think that's one thing that people have to watch out for, is that you might actually have the estate plan, but you need a tax team sophisticated enough to know that you do. That is a common issue that comes up. John, what about in expatriation? Look, for a lot of people, their best estate plan is to renounce their U.S. citizenship. Do you find that people create problems for themselves in renunciation by maybe investing in the wrong thing?
Well, of course, because to avoid covered expatriate status, they have to certify 5 years of compliance, right? Whatever that actually means. But if they're invested in things that are toxic to the U.S. tax system, and they have not. I mean, one of two things happens: either they've disabled themselves by reporting the stuff properly for the 5 years, in which case they have a problem, or they haven't reported them properly, in which case they have a problem. I mean, look. U.S. citizenship is a huge problem if you live outside the United States. The best estate plan for a lot of people is to renounce it. In fact, relatively early on, because it frees you up to do, a more reasonable plan. I mean, you can never know exactly where the world will be. I mean, the people who would not renounce U.S. citizenship are people who have a lot of assets in the United States and don't want to risk, being a non-resident alien owner of those assets, etc.
One story we did want to talk about recently that just came up. I got a great call from he's about 28, 30 years old. He is helping his mom run her businesses in Central America. Mom is not a U.S. person. Uh, the gentleman I talked to and his two brothers all are. And they said, yeah, mom has this pretty good, it would be otherwise a controlled foreign corporation, but she's not a U.S. person, so there's nothing to worry about. They just work there, take a small salary, not a big deal now. And they reached out to me to say, hey, look, we're kind of worried here that if we inherit this corporation, we are going to have a nightmare of nightmares in U.S. tax compliance. They said, we're not really caring that much about going, we live basically, our lives are in Central America. We don't care too much about them, being U.S. persons. We're thinking about renouncing. I said, you are picking the right time. I said, I wish I would have people to do this now. Now, again, look, whether you're renouncing or not, if it's a good decision, I'm not saying that is, but if it is a good decision, doing it earlier rather than later is probably the better timing, because in this case, our expatriation is going to be so simple. We have the easiest 5 years of tax returns to get in. We don't even have many unreported foreign assets. I don't even know if we need the streamlined program. It's a very simple thing. The form 8854 we're filing couldn't be any simpler. And, really our fees for him to renounce are going to be pretty low. They're going to get in and out because they're coming to us at the right time. Now, if they came to us the day after mom passed, good Lord. Okay, you can renounce, but now let's talk about the fun we're going to have renouncing and the various compliance that we're going to have to do, or maybe we have to do. And that's, I think, one of the other issues is that we have strategic uncertainty by the tax code. And I think one no greater area of taxation comes up is then with mutual funds. Mutual funds will be the one that people, and I will often advise people not to get a foreign mutual fund. And it's not because I think they're a PFIC. I don't, and they're not. There's nothing on IRS.gov that says any naked ownership of a foreign mutual fund is a PFIC. Nothing in there that says it is. Form 8621 instructions mention nothing of foreign mutual funds. John and I just covered this extensively in other podcasts, going over exactly why foreign mutual funds really aren't PFICs, but the tax industry is claiming they are, for reasons not entirely sure. But there's one thing too. So
Right.
You have strategic uncertainty. And then, as what John was saying earlier, here's something to keep in mind. That in the 2011 OVDI, the 2012, the ones that came after, the IRS invented basically everything. And they invented a few things. And if you look carefully, you'll never see it again. The idea that certain things could be foreign trust, like an Australian superannuation, okay, where we saw the IRS make that claim is one place and one place only. There's only one place we've ever seen the IRS make the claim that an Australia superannuation or a lot of these foreign retirements can be trust is in the OVDI. And why? Because the IRS wanted penalties. They wanted penalties. And they're like, hey, look, if we treat it like a foreign trust, we can get penalties. And really what they did in the OVDI is like, hey, look, if you don't like this, take it or leave it. Then you can opt out. Now, my firm, we were, I think, one of the very few firms who opted out. We did more opt-outs, and so we lowered penalties, and we challenged the IRS harder than any firm I know that did. And so the point is, when you're going to the tax industry, a lot of them don't even know where their mythology comes from. They don't even know where it comes from.
Right.
Yes, an Australian superannuation is a foreign trust. Where does that come from? Where does it come from? Oh, it came from the IRS's ad hoc determination, take it or leave it, that it's a trust. And Dennis Prager, the great attorney in LA, he did a FOIA, and he demonstrated how utterly clueless the IRS is, and that there is actually no determination by the IRS that an Australian superannuation is a foreign trust. There is no determination by that. But if you ask any expat tax expert, they will tell you with certainty, with complete certainty, that it is, and that the U.S. Australian tax treaty doesn't apply. And again, when you know where the IRS gets its entire basis from, kind of pokes that down. So that's also something to be aware of. What is your tax professional's knowledge of really where things are? Do they just sort of watch an IRS presentation?
Yeah.
And again, look, I sit through them all the time, and these people don't know what they're talking about. Go ahead, Keith.
Yeah. Right. Yeah. I mean, that's why, and you're making a very good, what's the word? calling, if you will, that it's okay to get a second and third opinion when you're trying to find an appropriate U.S. tax compliance professional, because there are good ones out there who do their due diligence, like you do, Anthony, and there are bad ones out there. And I'll just give you an example. While we've been on this call, I just had to ban a U.S. tax compliance professional from the American Expatriates Group, because he was spewing that if you don't comply with U.S. law, regardless of whether you are an American overseas or accidental American, you are going to be arrested at the border when you come into the United States. Well, that's a tax compliance professional to stay away from. Now, that's an extreme, but I had to ban him. I don't want that stuff in my group. It's
That's
unacceptable.
and that's
So
that
just
that
like when
is
you're going to a doctor, sometimes you need to get a second and third opinion.
that is someone who
Go ahead.
clearly doesn't understand reality and is absolutely using fear to sell their services, and that's so remotely true. Most people can get away with with tax non-compliance. I'll be honest. Around the world, I've talked to thousands of people myself, and they tell me, "Oh no one here is doing it. Nope, we do this. Nope, they're not going to find us." And there's various countries in the world. I'm not going to tell you where they are, but there's various countries in the world where the level of non-compliance is extremely high, and these things are laughed at. That is just so absurd to actually think. And then here's something to think about: how many audits of U.S. expats actually happen? How many actually happen when someone living overseas is actually audited by the IRS? I do know of a few cases here and there. I had a client once in Costa Rica where the IRS audited him, but guess what? The government has to ask permission of the Costa Rica government to come in and audit you. Permission was granted, and then the government has to pay a lot of money to fly that IRS employee who really isn't going to mind going to Costa Rica, really isn't going to mind. And it does happen. I do know of another case where an IRS special agent investigated a client's a business in Turks and Caicos, found out it was real. He enjoyed his trip. Could have just told him it was real. But the idea that there's this roving international. Oh, by the way, and they got kind of mad afterwards that they found out it was real. Like we went down to Turks and
Hey,
Caicos for no
Anthony,
reason.
I'm curious
Yeah.
about something. This is something new that I'm learning, and correct me if I'm wrong, if I'm misunderstanding you. If an American overseas, let's say in France or Germany, gets audited, does that
Yep.
mean that the IRS auditor flies to France or Germany to conduct the audit?
Well, that is a great question, and that is going to show you the distinction. There's two different types of audit generally. There's a field examination, and then there's a correspondence audit. The field examination actually can be an office examination, but I'm not going to get into that distinction. So the thing is, it's either so. So I know of one audit that was a field audit by the IRS, and that was that Costa Rica case. That was the one time I know of it in my 20 years of doing this. Never encountered it before. I have encountered about 3 correspondence audits of U.S. expats where they just send the mail. Now, the problem with the correspondence audits is oftentimes it's sent by mail and people don't get the mail overseas. So the IRS, too, limits its correspondence audits for Americans overseas. So if you really look at how difficult, it is incredibly difficult for the U.S. government to audit people overseas. It's expensive, and they don't want to do it because they know their employees want to have a good time. They don't want to do it because then the other employees get jealous. Well, why do they get to go to Costa Rica? Not me. I want to go there too. So it's really something they try to avoid. So when someone says like, "Oh yeah, you're going to be audited, you're going to be this," like, no, you know you're not, and they're really using fear. The issue is this: it's not about today. Hey, look, man, I'm not telling you that the way you got going on today, you're going to be detected. I don't tell people that. Like, I'm not going to say I don't know. Like maybe anything's a risk. But really, it's like at some point, you might need to come into compliance because of a U.S. inheritance, sometimes a new marriage, oftentimes a big reason why people get into tax compliance. My male clients, yeah, I'm getting married and my fiance is not going to deal with this crap. I'm like, okay, all right, we'll get you good shape for your fiance. And that's a big reason why people will do it. But the idea that there's some immediate threat, that there's some roving audit is not there. Where they'll get you is on automated penalties. They'll get you there. Now, the IRS does have all the FATCA data, and I assume they can do something with it at some point. But I'm not sure if but at this, they might be able to do it automated, but they still have a problem. This is the government's problem. They don't have the staff to answer the phones. Anytime the government
and they don't have the resources to go through the FATCA data. The former Commissioner Redding, was it last year, the year before, 2 separate occasions in front of Congress, stated they do not have the resources to go through FATCA data.
Well, I would say that's not. I would say it's true and false. They do have the assets to organize it, but they don't have the resources to do anything with it. Let's assume, because I think AI could put all that data in a usable format. But the problem is this: okay, well, who's going to do your audits? IRS employees. Okay, well, they're often the ones who know the least about international tax. So you have a whole bunch of people you have to train on the most complicated thing. And for those fans of this channel, people that listen, while you've heard this story before, I've repeated it a bunch of times. But years ago, I think this is now, I'm coming up on 10 years, when I talked to a group manager at my local office in New Haven. That's actually where I had one of my first, my first PFIC, which actually was a PFIC, because it was a PFIC. I was working there. So I called like, hey, how are you guys, how is your international audits going? And if you guys have heard this before, she laughed. She said, oh my God, yeah, no. I go, what do you mean? Why are you laughing? She goes, well, half of my auditors refuse to do anything international. I said, well, why is that? She goes, because it's too complicated. She goes, I'm not going to fire them because they're still good on domestic stuff. But the thing to understand is the IRS is intentionally confusing on international things. Well, guess what? That makes it incredibly hard to train a staff. The IRS has inconsistent, wildly complicated rules they invent and make up on their own. Well, that makes it really hard to train someone to do their job. A big place where this is coming up right now, is in the world of crypto. The IRS made a determination on their own in 2014 that cryptocurrency should be taxed as a security, basically property. Well, that was their kind of like their half-cocked opinion. But in doing so, this is what they didn't realize, that it's not a security. It's not a security. And really what you can wind up with cryptocurrencies is nothing but commingled assets. Regardless of the inventory system you're using, you can't track basis. And that is what the problem is. Now, they're not training their staff on that. They don't train their staff to say, yeah, we made this up. And yeah, you're going to find a problem because you actually can't, these are commingled funds and you really can't say what is the purchase price of this particular thing. You actually can't do that. They're not going to tell their employees that. They're going to say, hey, everything's wrong. But really, their employees are like, they get confused because their employees are told something is true when it's not true. That is devastating for managing a team. You can't manage a team unless communications are clear, and there's nothing clear about it. There's nothing clear about it. So that is always going to be the problem of the IRS, is they're trying to enforce something that's legally inconsistent. It's not consistent with itself because they're just doing whatever they get away with. And so that's one big problem. Why I would say that the tax professional you're talking about, no. The IRS doesn't have sophistication for that. What they can do is assess you a penalty because they saw something coming into the U.S. Maybe there's something they can do there. That's where they're going to get you. But the idea of the roving IRS isn't, internationally, it's not there. No, not at all. Not at all.
Well, remember, this particular tax compliance professional said that you'll be arrested at the border entering the United States if you're not in compliance. Bullshit. Pardon my French.
Yeah,
bullshit.
That's utterly absurd and disgusting. I do want to. We are coming up on time here. Just want to see if we got any questions coming in on any inherent things to do, not to do. See, Rob B is here. Yeah, Rob B. Oh, I'm with you, bud. I am with you. Yeah, we have clear. I think this is a good way to put on Rob to say this is the thing we've heard the phrase of, I think the phrase of the year. is strategic uncertainty. And that's what Secretary Bessent said. He goes, oh yeah, we're employing a campaign of strategic uncertainty. Boy, and that doesn't explain what the government has been doing to us for the last 100 years right there. Strategic uncertainty. There is so much ambiguity. And the tax industry is in cahoots with the IRS. They are the same team to create this ambiguity. Something I was thinking about, just, again, like if the U.S. tax compliance industry wanted to get rid of FBAR penalties, it could, because there's no authorization for it. It could, but it wants it there. It wants it there. And a lot of the legal industry, I think they sabotage their client's case because they want it there too. They want the FBAR there. They want these things there. They want this ambiguity because it makes them important and valuable. Without this ambiguity and terror, there's no value for the tax industry to provide. And that's really why they work in conjunction. And that's why you have to be so careful. And yeah, right. I mean, when we get to common law, I mean, that's where we get into a lot of the common law, clear and defined ambiguity. That's where we have. And again, that's really the problem the IRS has in administrating its own nonsense. That its employees it gets are people from regular people. They don't get some special secret asset of all the best people in the world who are ready, willing, and able to work for a GS-13 salary. They don't get that. They get who applies for the job. Who applies for the job are regular Americans. Regular Americans are who are tortured by the tax code. So there's no way they don't have the staff who can do this. They don't have the sophistication. The staff looks at the training. They don't like, okay, this is what I do. 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 But they don't know what they're doing. They don't know what it is. And that's really the biggest problem the IRS has, is they can't administer their own lies. That's really is. When you're lying, it's really hard to administer. And that's what we have. So let's see what we've got here. I do see that let's see here. We have Sherry. Good morning to you there. Good morning, Lori. Lori, thanks for joining us this morning. Any questions, let us know there. Let's see what we got. So I don't know if we have anything else, but I do want to talk about what we're going to do. John and I next week, where we're going to start to talk about estate tax. And for next week, what do you guys want to hit? Now, we did have an idea that we were going to do today, but we wanted to hit this too because estate and tax planning for U.S. expats is going to be a huge, huge thing over the next 30 years. And there's really not enough people who truly understands how difficult it is. What were we talking about next week? Keith, you had an idea?
Well, I think John had an idea about talking about the OVDI program.
Oh, that's right.
Am I correct in that?
Oh, yeah, that's right. Yeah, I want to get into that. I think the OVDI program is a perfect way to encapsulate sort of, without understanding what the OVDI is, you can't understand the tax industry today, and you can't understand the IRS today. You have to look at everything through that OVDI filter and how the IRS created a lot of law through press release, right? And honestly, this is the true statement. The OVDI was just a bunch of FAQs, that is, frequently asked questions. That's what it was. Like the first question, what's OVDI? That's actually what it was. It was just HTML code. It was just a column. It was a padded table with FAQs. That's all it was, and they invented it. And of course, when they invented this, just like when the IRS invents a lot of law, they paint themselves in the corners, and that's really the problem when you have a executive or an administrative agency really writing the law, which is what they do. And the tax industry lets them write the law because it benefits the tax industry. Now, one thing I would say that is a change in folks is there's big things that can be on the horizon. And as I'm talking to my groups here, so if you are getting downtrodden, I wouldn't be so much because we could see some big change. Yes, Robbie, absolutely. That's what I want. Exactly what I want to say. That's the Chevron deference is no longer in existence. Our Supreme Court is making big changes. And there are three big changes that I want to talk about. Number one, we had Loper Bright, which said that, hey, look, big policy decisions can't be decided by regulation. Well, a lot of the IRS's big policies aren't even decided by regulation. They're just like press releases, like the OVDI, like many other things, and also cryptocurrency. IRS Notice 2014-21 will not be in existence for long. It will not be. It is going to die. That was just some ad hoc thing. It's a major policy decision that wasn't even a regulation. It will not withstand. So that is one thing that will happen. And also, the big news is that we did see the Supreme Court with Justice Gorsuch really leading the charge on this, that administrative law judges, not a thing. And actually, Justice Gorsuch kind of mocked them, that we have administrative law judges pretending to be federal judges. Administrative law judges are not courts of law. They're not courts of law whatsoever. And the Department of Labor, they lost their administrative. I think the SEC did. The Supreme Court has not decided on tax court yet, but I do believe that is coming up there. Tax court is not a court of law. The entire process is totally illegal, and I think the IRS is going to lose its whole tax court. And without tax court, the IRS will effectively lose its function as a terrorist organization. It's going to be very difficult. They can still do it, but I think that's what we're going to see here as well. And we're starting to see, and so we're always seeing, where I'm seeing a lot of the positivity come from is the common law movement, of which I am a part of now, and I really enjoy it. So there is a lot of hope going on there too. As we're talking about the badness, it's exposing what the solution could be, and it's really a return to the really could do it and getting away. Administrative agencies aren't the law, and for too long they've been acting like the law. And even in the Doug Edelman indictment, I saw that Doug Edelman was criminally indicted for violating a regulation. Like, wow, you guys are really, so this regulation that sort of determined a major policy point you can be criminally indicted for. And also in a way that Roger Ver as well. Roger Ver is also indicted on basically IRS Notice 2014-21 because that's how the IRS calculated his tax owed in doing. So a lot of people that they're going after, the IRS is really exposing themselves, and they never have been weaker. I think with the current Supreme Court, with Gorsuch is really the one who sees it, and I think they're all following in there. So that's the great hope that that I have at least through this nonsense as we're enduring this, and we return to actual rule of law. That'd be amazing. That really would be amazing. I do want to just mention to people that if you are looking to get into engage with us too, is that you can find us on Twitter. A lot of these discussions go, and you'll see a lot of our will originate in there, and that's what we do like to do. We have to get that organic, really answering questions people have, and so you can find John at Expatriation Law on Twitter, and then Keith you can find at Keith_Redmond, and then myself you can find at IRS_Medic. The IRSMedic was me too, but I can't. Without the underscores, also me, but I can't find those login credentials, so I had to create a new one a few years ago. But that's a great place to reach out to you, and you can really see the discussion that's going on with some of the really great thinkers in the common law. And as it's developing, there are things going on. So I would say that if you are getting a little depressed about this, believe it or not, Twitter might be able to find you some. Following the groups on Twitter might really be able to see what people are doing. There's a really very intelligent people behind this movement, where we're really lucky. Borchelle, good morning to you. Good morning. Great, thanks for joining us there. Roger Ver is a smart dude. Oh my God, is he a smart dude? And I know he's got exactly. There's a whole thing with Bitcoin. Yeah, I know he's a very smart dude. And I think the whole Bitcoin thing, right? There's issues going on there. I just stay out of the whole thing. I do the tax part. But yeah, there's a lot of stuff going on. And with that, I do want to thank Keith and John, and I just want to send off. John, your final words today.
Well, if you're a U.S. citizen not living in the United States, there are three things that you can safely invest in that won't, cause you problems. Okay. The first are individual shares, publicly traded companies. The second is real estate, and the third is, just basic debt instruments. That is interest. Those are the three things that will not cause problems. That's the first point on the tax side. The second thing is that, people need to be, taxes. With the U.S. tax system, we have tax and reporting, right? There are certain activities that are reportable regardless of whether you have to file a tax return. And these are, generally having to do with business activities, small business corporations, if it's a corporation, okay, or, believe it or not, ownership in, if mutual funds are indeed PFICs, ownership in PFICs are reportable, whether you have to file a tax return or not. And this is a lot of baggage to carry around as a U.S. citizen. And one thing that wasn't mentioned today that I think is extremely important is you might ask yourself, is this worth the trouble? To have to think about this stuff all the time. And for many people, it's not.
Yeah.
I think a lot of people. I mean, I'm not saying people should definitely renounce right now, but I think that so much of the thinking on this is sort of habitual. I am a U.S. citizen, therefore I have this problem. Therefore, sort of how do I deal with it? Without considering that, a lot of the problems that most people have in life would indeed go away if they weren't U.S. citizens. And at the moment, that is possible. All right, whether it will be possible, 5-10 years down the road, I don't know.
Thank you so much. And if you are thinking about renouncing, I would say I really recommend reaching out to John Richardson, especially if you have pensions. He's the one. So if you are thinking about renouncing, John will really take a personalized, hands-on approach. You will get 100% of the attention you deserve. You are not a number to John Richardson, but a person. So I would really strongly advise you reach out to him. We did, and by the way, it
Right.
also
And Anthony with John also, if you're looking to give up your green card formally, to reach out to John.
Absolutely. And if you do have, and also again, what we started off with at the beginning of the show, if you do have your nightmare story of compliance, to send to John, he will help you again. And I would say, guys, the 2017 FATCA hearing only happened because of one dude, Solomon Yu. So people criticizing Solomon for Donald Trump breaking his promise to Solomon, I don't think that's the way to go. Solomon's still working on it. He asked for this. Let's help him out.
And if I may, and Anthony, if I may interject, the people with whom I've dealt over these years, Americans overseas around the world, guess what? They're Republicans, they're Democrats, they're independents, they're non-affiliated. It just does not matter. They are all getting screwed. It doesn't matter what your party is.
Yeah, it's us against them. That's absolutely right.
So one more interesting,
yep.
One more interesting aspect to this that is very, very problematic is that, if somebody were listening to this discussion, they might think, well, this is true for American citizens living outside the United States in any country of the world. But one of the most fascinating things about this is how the impacts are different depending on what country you live in.
True. Yeah.
And that's a gigantic problem. So, I mean, you can't say that, Canada, the UK have fairly modern tax treaties that mitigate the effects of this stuff somewhat, right? But there are other countries where there are no mitigating provisions at all in treaties, or I might add no treaties at all, right? For example, if people who live in Brazil, are subject to the U.S. tax code as it stands. So I really, I think it's so important for people to get their own situation understood, which consists of much more than assets and inheritances, but it's very much tied into the country where they actually live. And, I would even point out that a change in law in the country that you do live in, can sometimes have a profound impact on your U.S. tax situation or the application of U.S. law, right?
Yeah, absolutely. Well, thank you for that, John. It doesn't matter where you live, and I think where you're gonna, and I think it's just like not just looking at the snapshot of today, but what are the things that are likely to happen? Where are the countries likely to you go to? What? And
I think the U.S. is going to lose the ability to enforce this stuff at all.
Yes,
because the way
it has already. I mean, it has already. It only enforces by fear and intimidation. It actually doesn't administer. The law is not administered because it's too complicated. So it already lost its ability. It only can do it with fear and intimidation, breaking the law, and then working in collusion with the
Well,
tax.
that's on the retail level, but I think that they're going to have trouble. Basically, I think what's going to be happening is that the world has woken up to the fact that it has to deleverage itself from the United States. It has to. This has gotten so bad. The combination of these sanctions, taxes, the extradition treaties, that the only way that the rest of the world can survive as sovereign countries is by deleveraging. And, that's not going to happen instantly. But I mean, look at this thing, for example. Can you imagine, this 50% tariff on Indian products from India coming into effect? I mean, like, this is so insane, right? Not only from, the effect of what it will do for to consumers in the United States, but, we're talking about a country with a population of, something like 1.5 billion people. A very high percentage of them are below the age of 30. There's no possible way that, these legacy countries are going to be able to, really control a country like that. And then to tell them that, they're going to put this sanction on because they're buying Russian oil. I mean, that puts India or other countries in a situation where they're not going to like it. But their response is not going to be, oh, well, we're going to stop doing this. Okay. The response is going to be, well, we really can't be subject to this kind of coercion from the United States. So that's where this is going.
Yeah, I would say, go ahead, Keith.
I'm sorry. I just need to add something at the end. And this is where there is a cognitive dissonance with all of this. John's talking about, please send in your testimonials about double taxation so that way it can be submitted to Republicans overseas and Solomon Yu to get in front of Donald Trump. And right now, I just came across an email that just came through from Democrats Abroad Global Taxation. Okay. This is what they want you to do, a call to action. Tell the IRS to make.
To do what?
Yeah, we lost you.
To make filing free. To make filing free for Americans overseas.
Well, this is
there's a complete disconnect.
Well, how would you describe the disconnect? What is that? How do you interpret that, Keith?
Well, the way I interpret that disconnect is that there is not a singular voice from Americans overseas. Hence, there's no pushback on those entities or organizations who are not doing what they should be doing to address their constituents or their members vis-a-vis the problems of Americans overseas.
Okay,
so
let's unpack that a little bit. Okay. First of all, I'm going to ask the two of you a question, and I want you to reflect for a couple seconds before answering.
Okay.
Do you think that American citizens living outside the United States want to end citizenship taxation?
I think the ones with whom I have calls with do. Generally speaking, their lack of action indicates that they don't want to end double taxation.
Okay, let me ask the question a slightly different way. Do they want to end citizenship taxation in the sense of solving this problem once and for all people, future generations, or do they just want their specific problem ended?
And I would say this, John, is that the people that there's a wide, I would say most of them like the system as is. And the reason why is because many U.S. expats live on U.S. retirement. And so that there's really no downside to.
Well, that's one segment of the population.
Right. So there's one. And so I think the thing is it's a large segment. It is a very large segment. And also there is, and I think one thing that there's undoubtedly, especially we saw it in the election last year, when Donald Trump, and whatever politics are, who knows what they are, but whatever the case is Donald Trump is the one who promised to end double taxation for Americans abroad. Democrats abroad then kind of maybe came around to it.
No,
they never did. Then they never.
EA does, basically. I mean, they may have something on their website, but in practice, in reality, they're completely neutral.
And what I'd say is there is a sort of U.S. expat that is a lifetime tourist. That's kind of what I would say. They're a lifetime tourist in the country they're living in, retiring. They're going there because it's cheap and they like it. But they're still, and they like their friends in that country and they like the whole thing. But their Americanness is something they're not going to give up. It's really, they're going there with their Americanness. And
they don't. I think, that's part of it. But the larger part of it is that they're living off U.S. source income,
right?
Assets, right? I mean, that's
right.
The larger part of it.
Right. And so it's not devastating. So for them, it's very easy to stick to their tribal belief. Most U.S. expats are Democrats. So they're able to stick to their belief because it doesn't cost them anything. Their luxury belief of believing that, citizenship taxation is an okay thing is fine to them because it doesn't cost them a lot. But for the people that it does, and it costs them everything, and it's not just the cost, but it's, again, the amount of energy consuming from your daily life. Hire a tax attorney to solve the problem, and you're talking to this guy for the next 4 years. No offense, you are. I'm a nice guy, but we have a long relationship here. So that's what I would say. I would say some want it exactly as is because they're told what to do and it doesn't impact them. But then others clearly see the evil for what it is, for the total evil that it is. And I think it's a lot of tribalism.
I mean, I guess my feeling on this is, after having, been involved in this for many, many years, I don't really think that American citizens want to end citizenship taxation. I don't, I think some of them might, most of them don't. They're generally indifferent. The part of the problem in ending it is that although it is a problem that affects people regardless of political party, really, I mean, if you think in terms of Republicans and Democrats, only the Republicans seem to be concerned with ending it.
Yep.
The Democrats really don't. I mean, what I find astounding, I really do, I'll commit to that word astounding, is, you look at something like, this tax fairness group, this LaHood bill thing, right? And I'll be damned, I can't understand why there are no Democrats publicly supporting that. I mean, think of it for a minute. Think of it. And even, the head of the Americans Abroad caucus is a Democrat, right? This one, Dina, Titus or somebody, I mean, in Nevada. So help me understand that.
Yeah. All right. Well, I think there's a lot of things going on. I would say this. I think I think that where we will. What was I going to close on? All right. I have to hop off. I have a consultation with someone with some TFIC questions coming up in a few minutes. So I got to hop off. One thing I would want to just say is that if you are if you're looking for a tax firm on your side, you might want to reach out to mine, IRSMedic.com. We do a lot of tax prep. You can reach out to me if you have an issue here. There's my email right there, aparent@IRSMedic.com. If it's something you have a streamlined disclosure, you want to take a second look. If you want to take a second look at your, or take a look, the first look at some estate planning, maybe you want to create your own or you're set to inherit something. These are the issues that are coming up right now. And really, we want to avoid a lot. I mean, if you want to see some probate misery.
So let me ask you a question. Yeah. Is it even possible, for a U.S. citizen living outside the United States? I mean, isn't the part of the disability of this the inability to even do any estate planning?
Yeah, there is part of that. And that's where
there is a problem.
Well, and that's why I think for a lot of people, their estate plan is renouncing U.S. citizenship. It's part of it.
Yeah.
It's part of it.
Yeah.
Well, let me tell you a story.
John, I gotta
All right.
hop off right now. I gotta get on a meeting.
All
So
right.
we will next week when we talk about OVDI, that is going to be one
Anthony, the good
incredible
thing about this problem is that it will never go away.
We'll never go.
Okay?
We will never run out
Yeah.
of content.
So, Anthony, before you go, I don't know if you mentioned because my connection was a little bit dicey. People need to explore their options.
Oh, right. Thank you, Keith.
You
That's what I
know.
want to get. So yeah, reach out to Keith if you want to get if you want to explore your options before you make those things. You don't want to reach out to a tax professional, which might be a good idea. It might be a good idea. Reach out to Keith. There he is. Here is his email. You can reach him directly. And also, if you want to check out his Facebook group, here it is right there. It's growing all the time. And I guess if you are a tax compliance industry monster, you're not so welcome there, which is nice. Which is nice. So with that, I got to hop on another call right now. I want to thank everyone. Thank you everyone for the comments today. Appreciate it. We will be here next week. We'll be talking about some of the context to this misery, the 2011 OVDI. Thanks for joining us today.